Welcome, everyone. Thank you for joining us for another session of LinkedIn Live from Duke University's Fuqua School of Business. I'm Bill Mayew, a professor of accounting here at Fuqua, and I'll be talking about discrimination in financial markets. Today is the third episode in our special series around the issues of fairness, justice, and race. My colleagues Ashley Shelby Rosette and Aaron Kay hosted the previous two episodes. If you missed them or any of our previous broadcasts, don't worry, you can find those videos for replay right below this one on Fuqua's LinkedIn Live page. Let me begin with some brief background about me, because you might wonder why an accounting professor is writing papers about race discrimination in a bond market. Turns out an important theme in my research agenda pertains to how people treat each other. In an accounting context, I spend a lot of time trying to understand how CEOs of public companies treat financial analysts who follow their firms. One of my earliest papers documents that when a financial analyst has a negative view of the firm, the CEO tends to avoid taking questions from that analyst in public during earnings conference calls as a form of retribution. That is, CEOs discriminate among analysts and freeze out or make life difficult for unfavorable analysts. In my talk today, we will be looking at a different type of discrimination in a different setting. We are going to replace the CEO with a bond investor. We are also going to replace financial analysts with universities that want to raise money. And finally, instead of discriminating on the basis of how an analyst views a firm, discrimination will be based on the color of the skin of the students who attend the university. So ultimately, we will be assessing how bond investors treat or mistreat universities based on student race. That is, we will be studying race discrimination in the higher education bond market. You may well be aware that race discrimination has been investigated by scholars for decades. For example, you may be familiar with findings on race discrimination in the labor market, whereby Black workers, for example, earn substantially less than white workers for the same job. This wage differential is based on how employers treat workers of different races. Two main explanations are forwarded for the wage differential. One is that, on average, and an expectation, a Black worker is paid less because of characteristics related to the color of their skin. For example, a Black worker may be less likely on average to have health insurance or reliable transportation. In turn, they are a less reliable employee on average and are therefore, on average, paid less. This sort of race discrimination has a name. It's called statistical discrimination, whereby various attributes that are statistically associated with race underpin the wage difference. The other reason is that the employer just doesn't like or want to be around Black people. This sort of reasoning is called taste-based discrimination, and that is just the personal preference of the employer. Pinning down which type of race discrimination, statistical or taste-based, is important if we are going to progress toward eliminating discrimination. Unfortunately, in most settings, it is very difficult to isolate statistical discrimination from taste-based discrimination. One of the defining features of my study of race discrimination in the municipal bond market is that I can essentially rule out statistical discrimination. This allows for the quantification of taste-based discrimination effects. To show you how, I need to briefly explain some institutional features of the study. First, let me briefly explain how the bond market works. You can think of a bond as a piece of paper that just lists out a stream of cash flows you will receive as an investor if you own the bond. For a $10,000 bond that pays 5% interest for 20 years, each year over the next 20 years, you will receive $500. And then at the end of year 20, you'll receive $10,000 as well. Entities that need funding issue bonds. If corporations issue bonds, they are referred to as corporate bonds. If cities, counties, and universities issue bonds, they are called municipal bonds. Municipal bond market is very large at about $3.8 trillion. and wealthy individuals represent the most common type of investor. I'm going to focus on a particular subset of municipal bonds, those issued by universities. You will see why this subset of bonds is useful for studying discrimination in a minute. For now, suppose a university needs to build a $30 million dormitory and will issue bonds to raise the necessary funding. The question then becomes, who is going to buy the bonds? A single individual investor is unlikely to buy all $30 million worth, and it is not easy for schools to identify potential buyers. As part of what is called the underwriting process, universities hire investment banks to find the individuals. Procedurally, the investment bank buys the entire $30 million worth of bonds from the school and then turns around and sells them to individual investors. The investment bank charges the university a fee for doing this, and the fee has a name. It's called the gross spread. In the entire municipal bond market, the typical gross spread is 81 basis points, or 81 cents for every $100 in bonds. Gross spreads are higher for bonds with features that individual investors don't care for. For example, research shows that if a bond has some complex features to it, investors shy away. If the bond has a low credit rating, which means the likelihood of default or non-payment to the investor is high, investors don't want to buy the bond. Any bond feature that investors dislike makes it harder for the investment banker to find a buyer. Investment banks need to search harder to find someone to buy the bond. This drives up gross spreads, meaning that the university has to pay more fees to raise capital when the bond has features that potential investors do not like. The main analysis of the study will look at whether race is essentially a unique bond feature that impacts gross spreads. We characterize a bond as having race by whether the issuer is a school designated as a historically Black college and university or not. The Higher Education Act of 1965 defines historically Black colleges and universities, HBCUs, as accredited colleges and universities established before 1964 whose primary mission is educating Black Americans. HBCUs generally admit students from lower income families with lower SAT scores and have lower graduation rates compared to other schools. HBCUs are particularly important to study with respect to race discrimination because mandatory federal aid to HBCUs under the Higher Education Act of 1965 was explicitly acknowledged as partial remedy for past discriminatory actions by states and the federal government against HBCUs. That is, the government has admitted that HBCUs have been mistreated relative to other schools due to race discrimination prior to 1965. I'm going to show that they continue to be mistreated in more recent times as well. You may be wondering why an individual investor would be hesitant to buy an HBCU relative to any other university on the basis of race. The reason stems from the investor base that buys municipal bonds. Municipal bonds tend to be held by very wealthy individuals, and it is well known that the wealth distribution in the United States is tilted towards whites. At this point, you might be thinking, the investor base may well be tilted towards whites, but there must still be plenty of wealthy individuals who are not racist who would buy the bonds, right? After all, the municipal bond market is huge. If you have this thought, you're thinking like an economist. Capital markets are supposed to remove the impact of any sort of personal preferences like race. In large capital markets, the only color that should matter is green, the color of money. Additionally, in the capital market, the investor does not need to directly interact with the HBCU. The only interaction is the bond payment showing up in a bank account. This contrasts with the labor market where employers and employees might interact personally on a daily basis. So there are certainly reasons to suspect racism might not exist in the municipal bond market. Only by looking at real data can we make a determination. The statistical analysis is very straightforward. We simply need to obtain a sample of bond issuances from schools and look at whether gross spreads charged by the underwriters are higher for HBCUs or not. Our sample consists of 4,145 bond issuances spanning the years 1988 to 2010. The average issuance is $35 million, and the entire amount of bonds issued in our sample is roughly $150 billion. Our main finding is that HBCUs are charged 16 basis points more in gross spread than non-HBCUs. Given the average non-HBCU gross spread is 80 basis points, this means that HBCUs are charged 20% more to issue bonds relative to non-HBCUs. This effect holds after controlling for just about any observable factor you can think of, including, for example, the size of the issuance, the prestige of the school, alumni giving rates, etc. The most common response to our findings is that we are not really documenting racism. Rather, investors simply don't like HBCUs because they are more likely to default on their payments to investors. On the surface, this is a fair point. HBCUs are generally of poorer financial health than non-HBCUs. However, we find the same effects when we look at only the subsample of bonds that are insured. That is, we compare HBCUs and non-HBCUs that are both insured by the same insurance company. Because insurance pays if the school cannot, by definition, the credit risk of the school cannot be the reason we observe differences in gross spreads between HBCUs and non-HBCUs. While our results at this point are consistent with taste-based racial discrimination, they're not conclusive. If the findings are truly due to taste-based race discrimination, the average effects we document should be stronger in parts of the country where racial animus is known to be the strongest. We therefore create a state racial animus ranking by looking at, for example, opposition to affirmative action, racially charged Google searches, the white vote share to President Obama versus the white vote share to the previous Democratic candidate, John Kerry, and racist tweets in response to President Obama's re-election in 2012. After ranking all 50 states, Alabama, Louisiana, and Mississippi were identified as having the most racial animus. In these states, the incremental cost to HBCUs is 30 basis points, compared with 11 basis points for all other states. That is, the negative effects on HBCUs is 3 times larger in the far deep South versus the rest of the country. Given our results, you might be wondering, how could we go about fixing this? The ultimate reason for this phenomenon stems from tax benefits. Buyers of municipal bonds receive state tax exemptions for municipal bond income they receive, but only if they reside in the same state as the bond issuer. So, an investor in a Duke University bond will get a state tax benefit if they lived in North Carolina versus some other state. This essentially makes universities geographically captive to individuals in their own state. In states with high racial animus, it is really hard to find a buyer for an HBCU bond compared with states that don't have as much animus. So if out-of-state buyers were also provided a tax exemption, the market would open up such that the underwriters would not have to try and sell to a less than receptive local investor base, but rather could search nationwide for a buyer. One way to open up the market nationally is to make HBCU bonds triple tax exempt. With triple tax exemption, bondholders are not taxed at the federal, state, or local level on municipal bond income. A bill titled the HBCU Investment Expansion Act was proposed in 2016 based on the findings of this study to make HBCU bonds triple tax exempt, but ultimately the bill was not passed. One of the novelties of studying gross spreads in a municipal bond market is that they capture search costs. Recall, we're trying to find a buyer. This is not often the case in other studies of race discrimination because search costs are not observable to the researcher. It is easy, therefore, to gravitate towards data that are easy to obtain. For example, let's think about the labor market. Wage information is very easy to obtain, and it is very common to see wage gap data between blacks and whites. The gap represents racism, and shrinking it is an important goal. But suppose one day we observe no more wage gap. We might be tempted to conclude there is no more racism in the labor market anymore. But such a conclusion would be premature because we are only comparing outcomes after a job was secured. What cost was incurred by an individual worker to find the job? If a Black worker has to go on 20 interviews for one job, while a white has to go on 2 interviews, we have a racism problem even if wages are the same after the fact. So search costs are real, and identifying them is critical if we are going to make meaningful progress in eliminating race discrimination. At this point, let me stop and I'll take some questions. The first question we have is about the underwriting process. And the question says, is the effect you document possibly driven by predatory underwriters who are taking advantage of HBCUs? Since after all, HBCUs can't afford sophisticated finance departments. That's a really good question and something we thought deeply about. Our entire paper began with the notion of underwriters searching for buyers to sell the initial bonds when a school needed money. The way to remove the underwriter effect is to look in the secondary market, meaning that after the bonds have been placed in the hands of investors, if investors want to subsequently trade them to another investor, if our effect is real, we should see the search cost effect in the secondary market as well. And it turns out we do. And this is long after the underwriter has done their job and left. So we find similar 20% higher costs of trading in the secondary market as in the initial market. And so that evidence is pretty conclusive that the underwriter is not responsible, or a predatory, bad behaving underwriter is not responsible for the results that we document. One more question. Shouldn't big institutional investors who also invest in municipal bonds be removing this problem? So another way to say that is, usually when there's big institutional investors, if there's some problem that manifests from selling to individual people, these big institutional investors can wipe out that effect because they're so big and they don't have the incentives that an individual does. The answer to that question is we actually looked at insurance companies. And typically what happens is there's a phenomenon called home bias, which means that wherever you're located as a business, you tend to invest in local businesses or local universities. And what we find is actually the opposite for HBCUs. So there's in some sense an anti-home bias, whereby the insurance companies won't actually buy municipal bonds of HBCUs, even if they're nearby. And the reason for that is if the insurance company has to rebalance, they know that if they're going to have to sell that bond later, it's going to be difficult selling it in the secondary market. Let me go to one more question. It says the dollar amount, so the basis point difference between HBCUs and non-HBCUs is arguably not that economically important. Is it really big? Is 20% really a big deal? I think the answer to that is if you think about any corporation and you said to them, we're just going to add 20% more to your cost structure. In a competitive market, that would pretty much drive you out of business. And so this is actually a point that's important in terms of everything that you see with historically Black colleges, in terms of how you think about the difficulties they face. Overcoming that sort of cost differential is very, very difficult. And so, I would say it also has the effect of, imagine that schools know this cost exists, and as a result, they pass up going to the market to raise funding. So what happens? They don't refurbish their dorms, they don't refurbish their buildings, and as a result, they're unable to actually maintain their facilities. And that has spillover effects downstream, where maybe students don't want to participate or attend the school. So with that, let me conclude. Those were great questions. Let me conclude though, as academics, it's our job to listen to issues people face and use our skill sets to document fundamental facts that move beyond anecdotes in order to make society better. So please, if you see something, say something. Document what you can and use whatever platform you can to disseminate what you have observed. It turns out that the idea for this paper came from bond traders who were troubled that it was so difficult to place HBCU bonds. And so All I can say is, please, if you see something, say something. Don't be passive. It was a pleasure being with you today. Please be sure to watch the same time every day through June 18th. A link will be provided in the comments to the full schedule. Our next broadcast is Monday with my colleague Rick Larrick, who will discuss the psychology of stereotypes. Make sure you follow Fuqua on LinkedIn to get a notification as soon as the stream begins. Take care, everyone.